Hello, my name is Amelia, and today I will be presenting Crocs stock, which is a buy. At today's price of $125.05, our blended models point to a target of $147.64. That's an 18% projected return, roughly 8 points above the market's expected 10%. Now, first, for some context, over the past 5 years, Crocs actually lagged both the market and its sector. Founded in 2002, Crocs grew from a niche Colorado brand into a global leader in casual comfort footwear. It runs two brands, Crocs and the Hey Dude line it acquired in 2021 for $2.5 billion, led by CEO Andrew Reese from right here in Broomfield, Colorado. Now, Crocs sits in a consumer discretionary, which is the XLY sector. Over 5 years, XLY fell 43 points below the S&P 500. So, on a quick eye test, the sector looks like a hold or a sell. But XLY lumps in Amazon, Tesla, and GM, so it's no wonder it all feels kind of off. Looking at Crocs' actual peers, however, Nike, Birkenstock, and Steve Madden, analysts do rate them all as a buy. Now, the economic backdrop supports a discretionary brand like Crocs. GDP grew 2.1% in the first quarter, unemployment sits at 4.3%, and the Fed held interest rates at 3.5 to 3.75% off their recent highs. These numbers tell us that most consumers are working and spending their hard-earned money. So we ran 5 models, each looking at the stock from different angles. First is the analyst recommendation. Crocs averages at 2.79, which tells us that analysts are cautiously optimistic, leaning more towards positive. So that produces a target of $136.68, which is a 9.3% return. On its own, the A&R model suggests a hold, and since it's a real information-rich signal, we weight it at 30%. Next is the capital asset pricing model. With the 4% risk-free rate and a beta of 1.56, Crocs is about 56% more volatile than the market. And a 10% market return, the model demands a 13.4% return and points to $141.76. That's above today's price, so CAP-M signals moderate upside. Because it's grounded in real market data, we weigh it at 20%. Now, with the ratios valuation, Crocs' trailing PE is 34. Since its earnings collapsed last year, the trailing earnings per share were negative, which mechanically inflates the multiple. The forward PE at 9 tells us that analysts expect a sharp earnings recovery. Overall, the model implies a price near $470. We don't take that literally. It's a signal of undervaluation, not a price target, which is exactly why we weigh it at just 5%. Our anchor is the discounted cash flow model. Starting from 2025 free cash flow of $659 million with deliberately conservative growth assumptions, an 11.5% cost of capital, and a 2.5% terminal growth rate, it lands at an intrinsic value of $121.70. And since Crocs pays no dividend, there's nothing to discount, so we weight it at 0. Blending them all together, we arrive at a $147.64 final price. Our sensitivity analysis tests how much our answer would change if our assumptions are wrong. Adjusting the beta moved CAP-M price by about $1, and changing the analyst score moved its model by roughly $6. The forward PE swung the ratio model's price by more than $250. Basically, our valuation barely reacts to risk or to analyst sentiment, but it does live or die on the earnings recovery assumption. All in all, we are confident that the state of the economy and all of our models support a buy decision.